Today's video is for those of you that are hoping to retire early, whether you're 55 years old, 40 years old, or somewhere in between, or maybe even a couple years above that. You know, one of the challenges with retiring early is, at least in the United States, our systems are really optimized for people that want to retire when they're getting close to 60 or 65 years old. So let's jump into to some of those. First, and maybe the most daunting for a lot of people is there's a tax penalty in retirement accounts for a lot of retirement accounts if you retire before, if you withdraw the capital before 59 and a half. You can retire whenever you want. What the government cares is when you take the money out, right? They're trying to encourage you to let the money grow in these accounts, and so there's a 10% tax penalty with those accounts. So that's a challenge. I do want to let you know there are techniques, particularly as you get closer to 55 years old. I want to encourage you to talk to your accountant if you're thinking of retiring early, because there's a technique called SEPP, substantially equal periodic payments. I got it. I think it's Rule 72T. I'm not an accountant though. Definitely go see an accountant or find a fee-only financial advisor to help you with this. But there's different techniques that you can use to get your money out of these accounts that would normally have tax penalties. Also, like if you work for a local municipality, there are retirement accounts, I believe they're called 457s, that you want to speak to an accountant for sure, but in general, there is not that 10% penalty associated with that. So there are some techniques that can help you get the money out of your retirement accounts early. Go see an accountant. They're going to be your best bet on that. So that's the first one. The second is understand that a lot of the tools that financial planners use to help give people guidance as to how much money that they can take out of their accounts and not have a risk of ever running out of money, or I shouldn't have said it that way, have a very low risk of running out of money before they run out of lifespan, right? That your money's going to last you your lifetime. Tools like the sustainable withdrawal rate, which is how much money you can take out. Like, let's say you take $100,000 out your first year, and then you're going to inflate it each year after that. So if you're retiring the first year, it's $100,000. The next year inflation is 5%. You would take out $105,000 the next year, right? So tools like the sustainable withdrawal rates, and I have a video on sustainable withdrawal rates if you want to look up here. Hopefully that'll link to it. If not, I'll put it in the description. But tools like the sustainable withdrawal rate were really designed for 30-year periods, right? Somebody's 60 years old, 30 years later, they're going to be 90. Somebody's 65, 30 years later, they're going to be 95. And so if you tell somebody, you know, there's a 97% chance you'll never run out of money before you turn 90 or 95, for a lot of people, that's very comfortable. But if you're 40 years old and thinking about retiring, in 30 years, you're only going to be 70. So that's not going to feel so comfortable to you. So that's another negative with retiring early, or a challenge. And unfortunately, it's also a negative. And then the third one, particularly here in the United States, is you have to think through healthcare. What are you going to do for healthcare? Right here in the United States, our employers, oftentimes, that's how many of us here in the United States get our health care. It tends to be very expensive and difficult to get here in the United States outside of an employer. So you'll need to look into that. Again, one great place to start with that is just simply healthcare.gov. They've got a lot of tables. You can get a feel for what, you know, if you have to pay for healthcare yourself, what's that going to cost? So those are the three challenges and places to look to get going and things to be thinking about. And then the powerful technique that's going to help you out in retirement is really what I call the 3-bucket strategy. And that is thinking through where your money's going to come from in retirement, and how much of that's going to come from a taxable account like a local bank account, how much of that is going to come from How much of that is going to come from a tax-deferred account, things like traditional 401ks and traditional IRAs. And then the third one is what I call a tax me now, but not later account, which are Roth versions of those accounts. Now, many of us, if you're around my age, we were kind of raised, boy, put as much money as you can into your 401k. And there's definitely there's some truth to that, but like any rule of thumb, you can carry it too far. You know, oftentimes employers will match a percent. Typical is 2, 4, 6%. I've heard, you know, some companies actually match quite a bit more. So putting money in the 401k up to the level of your company's match, right? That's kind of what we call free money. That probably makes a lot of sense. But above that, you want to be thinking through, gee, when I'm in retirement and I need to take money out of the account, how much of this is going to be taxable? If all you have is a traditional 401k and you're 55 years old, you don't have Social Security coming in, you don't have a pension, and you're paying the 10% penalty, boy, that's a lot of tax that you're going to have to pay. But if you have money in like your local bank account, where every year the interest that you pay on the bank account, you're tax me as I go. That's a tax me as I go account. Now all of a sudden you can take some money out of that, and you're paying tax as you go on that. So to get the cash flow out is not a taxable event. Where with your traditional IRA and 401k, it's going to trigger ordinary income. So, and then the fourth one, not the fourth one, the third bucket is your traditional Roth version of your 401k and your IRA. And again, you want to talk to your accountant, but in general, you can take out the money you put in to your Roth, your contributions, and there's no tax on that. The government would love for you to spend that money, right? Because yeah, that's gonna, if you don't take that money out, it's gonna continue to grow tax-free until you do. So it's in the government's benefit for you to take it out and spend it sooner. So that's the last technique. Hopefully you find it powerful. I can tell you, a lot of people when they retire, they haven't thought about that ahead of time. And it's kind of hard to catch up and build sufficient assets in each of those bucket categories. So I hope you found this helpful. If you did, do me a favor, hit the like button. It really does help my channel grow. Do leave me a comment. I do read the comments. I think we're building a great community here, and I love the comments. Let me know what you found helpful in this video. If there's videos you'd like me to make in the future, let me know that. I'd be happy to consider doing that. And until next time, I'm Azul, encouraging you to take full advantage of the youth of your senior years. Remember, you're only young once. Use this time wisely.